All right, everybody, welcome to Cover Call ETF Investing. And today I have a special new face to the Cover Call ETF landscape. Carl Chung, Executive Vice President and Head of ETFs at Ninepoint. So, Carl, welcome to the channel. We're going to be talking about the high shares that you have all just recently launched.
Thank you for having us. Really excited to tell my story, the 9 Point story, and really connect with your audience here today.
Absolutely. So before we start, we talk about the single stock cover call ETFs, the high shares that Ninepoint has just launched. Can you tell us maybe a little bit about yourself, what your role is at Ninepoint, and then maybe a brief history about Ninepoint?
No, it's wonderful. Great place to start. So I spent nearly 20 years in the ETF industry. Just in some of our conversation a little bit earlier, it was a time when there was only four providers. You think back to when BMO had first entered, and there was only three providers. One, the firm I had worked for, is no longer actually in the industry. It was acquired by BlackRock. But back then, there was less than 100 ETFs available on the TSX. You can imagine that. I don't know. I was just taking a look at the last statistics from TD, but like we're talking like over maybe 1,500 ETFs are now trading on the various exchange. So there was a lot of white space when we had started. So I'm proud because I feel like I've helped educate the marketplace and building it to the $600 billion market cap you see in Canada. And so early days, I was able to launch first market products like the first gold bullion ETF that I was involved in, first US dividend ETF. I worked on the first suite of laddered bond ETFs. So these are all products that have helped grow and build the industry and build awareness. So I've always focused on bringing innovative solutions, trying to solve some problems for end investors. At Ninepoint, as you mentioned there, I do lead our ETF business. I did join in May, so we're happy to be out so quickly with our suite here and high shares. But Ninepoint itself, just a little bit about us because we might be new to your audience. We manage about 7 billion, manage and oversee 7 billion in assets. And that makes us one of the largest independent asset managers in Canada. What makes us different, I believe, in our philosophy, what attracted me, extremely entrepreneurial firm, but just the philosophy of what they call initially called alt thinking. So we just don't replicate broad indices. We try to solve real investor challenges in very modern ways. And we've done that, we believe, with this high shares is a perfect example. What we're doing here, and we have some first mover advantage on this area of the marketplace. We're really transforming Canada's most trusted blue chip companies into innovative income solutions. And I'm happy to get into that as we move this interview along.
Mhm. No problem. And Carl, you were mentioning that Ninepoint has about 7 billion in AUM. I think if my research serves me well, 500 million is in the ETF space that Ninepoint has put out. With the launch of your single stock cover call ETFs, high shares, do you think that going forward you're going to be maybe focused more on the active management side of things with the ETFs?
I believe we're going to be in that area there. Just given our expertise, our history of the firm, we are very much, the firm was founded on trying to find alternatives, ways to provide value to the end investor. And so what that meant is that we're looking at a very active and risk-focused tilt on various marketplaces, whether it be energy. Your audience probably knows our energy fund, NNRG. I know it's been popular in the social media channels run by Eric Nuttall, to our commodity that where the history of the firm has been on the commodity side, whether it be gold bullion or silver bullion. We also have a great gold and mineral mining, and we do provide some active management tilt on several of these areas. Just talking a little bit about like our history and where we started, we're pretty much known for the mutual fund side of the business, and to say that's given us a real strong foundation mutual funds were predominantly active management at that point, and then that's been in our DNA since the beginning. But going into this space, the ETF wrapper and introducing these products, it really brings undeniable advantages. And that's why I got into the industry. I was using ETFs in my day to day. And I said, these things are a lot more flexible and cost effective than the actual mutual fund wrapper. And that's really been the innovation in the financial services industry, one of the greatest. And so whether it be the transparency, the liquidity, the efficiency of the structure, investors today are they want to know exactly what they own, and that's exactly what ETFs deliver. So when it comes to active mandates, Highshares isn't about just passive exposure. It's really outcome driven, like many of our mandates that you're going to see in the marketplace.
Well, that's perfect. And for the audience, just to recap what you had just mentioned, Carl, and I think this is a key point when it comes to Ninepoint. Ninepoint isn't just a firm that just that came out of nowhere, a couple weeks ago. You guys have been around for a long time. You guys have experience with your teams managing the mutual funds and your ETFs. Once again, 7 billion in AUM is nothing to sneeze at, especially here in Canada. It is quite impressive. So just that's a key point there with how we're about to talk about the Highshares products. But with that being said, let's talk about that and talk about the funds that you guys have just launched, and you can see it on the screen here. So these are the Highshare products right off the Ninepoint website. Maybe just let's just talk about, like, why did you choose the companies you picked, and maybe just chat about the sector mix, or just get your thoughts on the sector mix.
Yeah, and maybe we just start off on that front. In Canada, it's going to be a little bit different in the US, as your audience members know. The US, clearly, you have some very large technology companies, the Mag 7, that dominate the market cap and the weighting of technology in the overall benchmark. And when you see, and you're talking about energy, you see energy is less than like a 5% weight in the S&P 500. Now you go over to Canada, it's a little bit more of a cyclical market, right? Like when you take a look at energy and banks and financial services, that represents over 2/3 of the overall index, right?
Mm-hmm.
And so the sector mix is going to reflect more of the Canadian constituents and makeup here. And so we launched with several companies that are very, very well known. And part of the research behind it, just the inner workings of how we thought about this, is that we had some relationships with some of the direct brokerage channels, and we wanted to get some information and some feedback as to what are the most widely held names in those channels. And so when you take a look, I would argue that many Canadians would know these companies extremely well, whether they pay the bills or bank with them. You have RBC and Enbridge, BCE, Barrick, Shopify, CN Rail, TD, Cameco. These are very household names that are very widely owned by Canadians, but also very trusted. They have long histories. They've really built the Canadian economy and represents very much the Canadian economic engine. Banks, energy, telecom, gold, these are all the areas there that we have grown to these kind of market leaders that you see in our starting lineup. The other side of it is very important, and especially for a covered call strategy. Now, we're not writing 100%, but we do need very liquid options, as we're writing up to 50%. And liquid options market, both dual-sided, like you have Canadian listed. These companies are all cross-listed, so there's an options market is there. So you have very deep options market that makes it essential for really sustainable covered call strategies. And for simplicity, in addition to all of this, so you have your individual companies, but we also created an everything all-in-one solution called ECHI, which really bundles all of them into a single ETF. And when you look at some of the competitors in the industry, you're going to see over time, it should provide an improvement on the yield front as well. So that's really how we thought about that, Tim. And again, you'll get into some of the others, but we're looking to also build that out over time.
Yeah, I think from my audience's perspective, I think when it comes to investing in cover call ETFs in Canada, I think one of the called the raps that it gets is that the options market is not deep. So right. So I think that's a really good explanation that being dual listed helps out with, getting those deep options markets so that, you take advantage of the higher volatility that's out there. And at the same time, a lot of these companies also pay high dividends as well, which is really nice to see. So you're not simply just relying on the premium income, like you do also get as a part of that, the dividend income as well.
And I think that's a very excellent point. And going into that, how we pick the names a little bit even further is that we decided when we take a look, clearly there's interest. We talked a little bit earlier before this call here. Is that there's an interest on two like separate demographics we think for these type of products. When you think of the younger generation, they might be interested in the Shopifys and the Camecos that are gonna have high option premiums, higher yields, just by the option that's generated. Shopify itself does not generate or Cameco dividends at all. So this provides dividend income to a strategy or to a company that typically does not pay. So your option premium should be a little bit higher. Then you have the other side, you have the retirees or people close to retirement that are very interested in the BCEs and the Enbridge and RBC, but their volatility is going to be a little bit less. Now, RBC is an example where their dividend is about 3-4%. With the option premium, you might get a few more. And then with the expected return of the stock, you get to a higher level. So maybe 3%. 3-4%, or even a TD at 5% might not be enough income per month. And these type of strategies will add income over and above that, like you mentioned there, that very sustainable dividend yield you typically have for a bank or an Enbridge that's increased its dividend for decades. And I think that's hopefully appeals to two different segments of the marketplace.
I think it does, Carl, mainly because we've seen other products that are single stock cover call ETF based, whether it be here in Canada or in the US. But it focuses on U.S. equity, which it means it's going to be really top heavy with the tech side of things. Whereas at least with this lineup, what I really like about it is, yes, you get to invest in Canada, keep some of those investment dollars here in Canada. But like you said, you got gold, you got telecoms, you got pipelines and railways, and you got right Shopify with tech, which is if we get a strong tech company in Canada, I think we're like I'm sure we'd love to see more, but good to see that in the mix as well. But anyways, much more diversified as far as the sectors are concerned. So I think there will certainly be interest from investors when it comes to that. Now, as we get kind of a little bit more into the fund details, maybe you can just talk about sort of are these products meant to be more sole income plays, or are you looking to sort of balance the potential capital appreciation with the distributions?
Really, really important part for your viewers. Income for this strategy is a core focus. Let's not deny that. We're trying to provide income over and above the existing dividend yields where they're paying it, as I mentioned, or generate income for companies like Shopify and Cameco that historically not pay dividends. So you're getting an income, getting paid while you're growing with the portfolio. Now, we really want to emphasize that income is the core focus, but not at the expense of growth. And so the way we do that is we don't write calls on 100% of the holdings. So what we usually do is write them a little bit out of the money as well, leaving upside potential if the markets rally. So I think that's a very important point because this product will write 50%, up to 50% of its holdings covered calls. We're also going to use a component there to boost the yield, a modest leverage of up to 25% for more of an income lift. And then what this allows us to do is this. If the market dynamically pulls back and calls might look a little bit more attractive, we might not need to write as much, right? So as an example, a Shopify might has high growth potential going forward. We're talking about a compounder of close to almost 100% over the last decade. And so over time, you're going to want to participate in that growth. That 50% already is going to be exposed to the stock. And so that's fantastic. But we're also going to manage the options that way as well. Now, if we, the Shopify just reported earnings, it was up over 20%. You want to capture as much as we can. So what we're trying to do with that strategy, the Clever Carl side, is we're trying to ladder it, different maturities, different strikes, different coverage levels to take advantage of that upside potential. Because we really believe in terms of the stock's growth potential, it could still have a very attractive return going forward. So we'll be paying distributions on a monthly basis, which we think is important for those looking for income, but they're going to be variable. We're not going to overpromise or try to erode capital that way. We're going to manage distributions in terms of the market volatility we see, and to make the goal very sustainable income today with NAV stability over time, so the NAV grows. And I think that's going to be really important in order to not just invest but to actually grow over time. And you said to yourself, you're more of a growth, long-term compounder investor. What we've seen live term, some of the products are out trading on the US side, like you mentioned. And that experience has shown that you can still participate with lots of the growth with this thoughtful strategy on the upside. And, I can get into how they perform in various environments. But if there's a modest bull market, you will see pretty good, strong capture of that. It tends to trade at a beta of close to 1, which is phenomenal, right? So you're still capturing lots of the return, but generating income.
Perfect. And for these funds, Carl, I mean, what can investors expect from things like fees and payouts? And I mean, you know what? I'll save my tax questions maybe for later in the interview. But maybe just on the fees and payouts alone, what can investors expect?
So fees, I'm really happy to talk about that. So fees, Ninepoint has made a business decision that we will waive the fees for the first 6 months up until February 2026. So the management fees, I should state explicitly, will be waived February 2026. So it will be zero management fees. There's going to be leverage costs that we'll know at one point throughout the year through the modest leverage that we're employing through the strategy. But the management fees will be zero. And then after that, it's just going to be 0.29% or 29 basis points. That will make it the lowest in Canada for single stock covered call ETFs. And what that means for the end investor, of course, is that more returns will stay in the investor's hands, whether it be the dividends or the capital gains that we're generating through the strategy, which I think is really, really important. So on taxes, it's really an important point too. You had mentioned, on the U.S. side, some of these companies might be paying dividends. They might have a withholding tax of close to 15% on those dividends, and so it's not a complete flow through. Now you have Canadian companies. As many of us know, the dividends are treated on a very favorable tax dividend treatment here in Canada. They're grossed up, and you keep more of what you're earning there. That's one component. Two other components really need to think about here. Capital gains, of course, through the option activity, the incomes you're generating through selling covered calls, as your audience knows, is in the form of capital gains. Very attractive treatment, half the rate of income. And then there's going to be a component, and we see with all these type of strategies, there's going to be a component of return on capital, ROC, that will be part of it. And that's just a return of your overall capital and lowers your adjusted cost base. So when you sell, you have a capital gain there. I think the most important thing when you look at taxes is never really the decision you need to make when you're investing in any product. I think it's one of the factors. It can't be the leading factor. It should be the underlying strategy that and what you're investing in. But it's really important that tax efficiency, Canadians care a lot about it. We all do. And I really feel on this front that you have to think of the total return of the overall strategy when you incorporate all of those dividends, capital gains, return on capital is really determinant. So as kind of like a benchmark, take a look at what they call the TRA, the total return of everything after taxes will give you a good assessment of how these are. But I think just because the Canadian companies are involved here, it does provide an element of a tax advantage through the dividends.
Okay, I just want to just back up a little bit here. And do you think you could maybe just explain a little bit more of like what ROC is? Because that typically gets a lot of attention in the income community. It's kind of, it can be a bit of a fuzzy thing to understand for investors. But is it truly the return of your own money coming back to you, your principal, or is it just a tax classification? Can you go into maybe the into the different layers of return of capital and what that can mean for investors?
Such an important concept, and we had discussed it. We were seeing it so much online, and it's very high topic. So let me try to explain it the best way I can here. So one of the things you'll notice with Ninepoint Highshares or covered call ETFs is that some of the distributions is going to be classified as return of capital. So is that bad or good? Let's dive into it. Like, so when you take a look, return of capital industry kind of nomenclature, they call it ROC, simply means you're getting part of the original investment back, part of the cash flow. So it's not immediately taxable like what you would have like interest or dividends. Instead, what it does is it lowers your cost basis, which means it will defer taxes until you actually sell. With the Ninepoint Highshares ETF, what you see when we're distributing ROC, it isn't a sign of weakness. It's actually a design feature of a covered call strategy. Because when you have option premiums, which can fluctuate month to month, using return of capital allows you to keep distributions smooth and predictable for investors rather than having them jump around from month to month. Because as I mentioned, like RBC doesn't pay dividends on a monthly basis. And so this will help smooth out that return. So while part of your distribution might be labeled as return of capital, the important thing is to remember is that Highshares is really, and Ninepoint Highshares and other covered call ETFs are trying to maximize income, and in our case, from blue chip Canadian stocks. So while return of capital, you mentioned accounting, is really more an accounting mechanism that helps deliver income in a steady, more tax efficient way.
I know this is certainly going to be top of mind for cover call ETF investors, and that is going to be are the target yields that that you could maybe discuss here with the individual cover call ETFs in this lineup, and then the all-in-one.
Regulation in our industry prevents us from explicitly stating the yields of the actual ETF for the first year. So, but let me give you some context. I as the number one takeaway, when you're looking at any individual stock, we'll start there. The income from these products will always meaningfully be higher than the stock's dividend alone. We talked a little bit about that, but that's point number one. Now, the yields will differ by company and sector. And going into some of the earlier conversation, tech names like Shopify will typically generate higher premiums due to the volatility. I think your investors clearly understand that, seeing higher volatile tech stocks currently being offered. Mm-hmm. Defensive names, think like more of like a BCE, and I mentioned, they haven't compounded as quickly as Shopify for sure, generate lower but very stable yields over time. We're talking about like close to 5% dividend, and then you add on some option premium. But the volatility of the stock is much lower than a Shopify, as we all know. So you won't get the 20% plus, let's say, yields on a BCE. You can expect a more modest, but still very attractive, and definitely more than the stock's dividend alone. When you're talking about ECHI, which is our wrap portfolio, we're taking all of these individual securities, we're yield weighting them. That's the methodology behind it. And, so what that means essentially is the higher yielding ETF stock that we're holding, the Shopify's Cameco, will have a higher weight, and then we're allocating the rest proportionally. So investors get a real blended approach. The income is going to be diversified across the various sectors. And the important point is that yields will be meaningfully higher than the underlying stock alone. And even covered call ETFs, just given the modest leverage we're using and an option strategy, we think it could be double than what's currently offered for Canadian stock covered call products as well. So the advantage of combining covered calls with leverage in a very disciplined way will lead to very attractive income at a very low cost, lower than most other covered call products, is really the takeaway.
I think you might be the first person I've ever heard to use the term yield weighted in as far as like a diversified fund is. I actually like that because as far as I'm aware, and the audience can certainly chime into the comment section on this one, but sort of the other single stock cover call ETFs, wrappers that you talked about, they're all in one products, whether it be here in Canada or in the US. I think they're, for the most part, they're just equal weight. So the fact that so that can potentially mean a higher yield in your, single stock cover call ETF, all in one. Potentially being maybe a little bit higher than other competitors out there. But that's just me speculating on things. I know you probably can't go too far into that, so that's just me to the audience there on that. But I do like the term yield weighted.
Yeah, I'll let you and your audience derive the math themselves as we post our distributions.
Absolutely. So once again, for the investors out there, obviously that's it's pretty critical on one from their end on this end. We're always going to be curious about yields, like always and forever, no matter who I talk to in interviews or offline or at work or friends, family. Everyone just wants to know yields. Yield. It's always a discussion about yields. So just mind the curiosity there. Will these funds pay weekly, bi-weekly, or monthly?
Oh, that's a good next question there. So this will be paying monthly. Like at this point, it's kind of interesting to see the evolution of the industry. That I've seen some bi-weeklies now to match an investor's income or supplement their income that they might get from their paychecks, as an example.
Yeah.
But these strategies will be monthly pay, set at the end of the month and paid a week or so after the actual announcement on settlement. So our first distribution, where we're going to be announcing it very shortly, will be paid in October. And I think investors, when they take a look at how attractive some of these companies are paying out, will be very happy with some of the income today that they'll be getting.
Oh, perfect. Yeah. I mean, I mean, monthly is, I think, to be expected on the most part. We really only have a couple of funds here in Canada that pay bi-monthly. It's just like you could count them on one hand. Certainly a lot more in the US. But I would say there's more discussions percolating these days around, I would say maybe a little bit of more of a tilt towards weekly not being as efficient as, say, being able to pay out monthly. And I know that there are right there's we can certainly get into that's probably for another conversation, the strategy behind that. But anyways, at the end of the day, monthly is the typical way to go. So sounds good there. And what will the starting price be on these high share ETFs?
So really critical. Every ETF in the lineup was launched at $10 per unit. We actually just started trading yesterday, and that was very, very intentional. We're trying to keep things simple for new investors. They'll know exactly we started at 10. Also, what it does is really democratize these type of companies in terms of fractionalizing its shares. You think of like an RBC or a Shopify and the $200 or $300 handle. This now brings that cost down to $10 per unit plus additional income. So while being scalable enough for institutions, what this offers is like, think of it like your TFSA or your RESPs for your children there. They're a little bit more difficult to get access to these higher price stocks. I'm thinking to myself, like, even like some of the stocks like a Constellation or Fairfax, $4,000. I mean, that's not in the portfolio, but they're very difficult to add to portfolios. So this is a very clean entry point, and it makes it accessible for all types of different accounts and investors. And that's the beauty of ETFs. You just really need to buy one unit. You could just buy $10, and you own one of Canadians' iconic companies that are generating very attractive yields. That's wonderful.
Yeah, that's what I appreciate about the lower prices too. It's more of a psychology kind of thing. I think
It
that's why
is.
you see
Yes.
Company split is just, if someone sees, like you were mentioning, the $4,000 unit price or share price of anything, it just looks too daunting to get into. There might be, your brokerage might have a fractional program that's been initiated. But yeah, I think at $10, especially if people can feel like they're really compounding the units and they're getting up into the thousands of units, 2,000 units kind of thing on a $10 unit price, I think there's probably a psychological element to there. Just to get as many more shares as humanly possible when it comes to reinvesting. So no, I do appreciate that, especially at $10. Like you said, that's a good point. It's easy math from there. Um, as far as the diversified fund, ECHI,
100%.
which is the diversified fund, it's got that 25% leverage. Can investors think of this as like a concentrated TSX 60? Would that be fair to say?
We're focusing our strategy here on the ECHI on the Canadian leaders that have built the economy and that have offered investors, whether very high dividends in the case of Enbridge and Canadian Natural Resources that have increased its dividends consistently for decades, or the second largest global uranium player in Cameco, the leading tech company in e-commerce and Shopify. And so what we're taking is, to your point, we're cherry picking some of the most well-known, iconic companies that have built this nation.
Hmm.
And we think it's a great way for Canadians to participate in long-term growth of the Canadian economy. These companies represent all sectors. As we mentioned, they're very diversified on that front. And we're getting it a little bit more concentrated. So that's kind of the benefit as well. You own broad-based ETFs. You're really owning all of them, and not good and bad, which is historically has been great for investors to really just own the broad-based indexes. These ones here, we're going to offer the market leaders in every category at a higher yield and distribution with a low fee. So that's kind of the thought process behind that. But with regards to your comment, I think that's a fair one.
Yeah, there's certainly other products out there that maybe try to mimic the sector weights of indexes, even though they're just cherry picking uh, the stocks within the portfolio. So yeah, I think for investors I think that's a good explanation, just so that you guys are not doing that. You are not just stock picking to make up a sector mix, so to speak. All right. I just kind of wanted your thoughts on using leverage, because there's certainly some investors out there, albeit there's plenty of covered call ETF funds that offer up the 25% leverage. I believe there's one fund out there with 33% leverage. Well, actually two now. What would you say to maybe the concerned investor when it comes to leverage? What is the benefit of using leverage in cover call ETFs like you are, or that Ninepoint is using within the Highshares lineup?
So these ETFs, I think when it comes to leverage, we're using what we deem as modest leverage. So up to 25%. We'll be in a range, I'd say closer to 20% of that. And so what that adds is yield. And this is based on our modeling and our internal testing and the math behind it. What
Hmm.
it does is add yield without being overly aggressive on the option selling side. So we don't want to, especially with the distributions, we want them to be sustainable, as we said, over the long term, factoring different areas. But we don't want to be just relying on the option selling to generate that high additional yield, because volatility, as you know, could go up and down in a month. So with the modest leverage up to 20%, we're actually adding a significant benefit to the end investor. But I've tried to use Margin, my online account at RBC Direct. I'll maybe give them a plug there. But you got to do a lot of work, right? You got to do a lot of paperwork, an understanding, and then you got to pay borrow cost. And you know, I won't get into the specific details, but like a firm like Ninepoint with a $7 billion asset base, we can borrow at a much lower yield than an end investor, like half of it, and I would say even more than half
Yeah.
lower than what an end investor can. So we add this modest leverage, and what that does with the leverage, say going up to 20-25%, is it creates a more one-to-one exposure with the underlying stock in modest and bull and bear markets. So you're tracking the individual stocks, you're generating income because, you know, that might be a goal of yours, or even if you're extremely bullish, you just want a portion and that has the income. And so what that does then is that it gives investors lots of options, is where I'm getting here with that, without taking excessive risk. Where I've seen companies, and internally I was talking about this, where I've seen companies that have got into trouble is when they're using 100% leverage. And in times like 2008, that's when, you know, the tide goes out, with the Warren Buffett saying, you see who's wearing swim shorts at that point. And so with this measure, we're not overly aggressive on this front. We still have 75% of the portfolio that has direct exposure without the leverage. So you're going to get that, plus without sacrificing long-term capital stability of the actual product itself.
Leverage has really become just an incredible norm in the cover call ETF space up here in Canada. On the American side of things, it's so wild, and this is just for the investors out there right now that they're probably not aware, but there are no leverage ETFs in the States that are what I would maybe call, I don't think this is like a proper financial term, but long leverage. It's more of the kind of leverage that that is typically employed up here in Canada with the various cover call managers and the 25% leverage. Whereas down in the States, it's more of that derivative leverage, the daily trading kind of leverage down there. So you're not able to access exposure to these similar kinds of funds in the States and just and hold it for a long period of time and still track the index as well, because you know a minor lesson there for the investors, right? If you just invest long term in the daily kinds of leverage, it's not going, like, after a day it's going to totally separate, and it can no longer track with the index long term. So I think that's also another key point with the leverage that's using that people can think of it as just kind of ordinary leverage, like you were mentioning. It's the kind of leverage that you would say borrow from a brokerage account in your marginal account, so to speak, right? But at least this way you make it a lot more easier. And I think that was a really good point you made about it's being able to access leverage this way versus accessing it yourself through a margin account, is that with 7 billion in AUM, like you said, you get a way lower interest rate. And I know that's I know that for many investors who follow this channel, I know you all are really aware of that kind of thing, but I don't even know if many investors are aware of just potentially how much of a discount you can potentially get. So if it's around half, that's incredible. But I guess that especially like you said, 7 billion AUM, shouldn't be really surprised there. Now speaking about speaking about the other fund managers, there's roughly about 7 major providers here in Canada. What can potential investors expect that might be different with Ninepoint versus maybe the other fund providers?
And everyone's got a specialty. Otherwise, it wouldn't be a business. And they're all very, a lot of them are very successful businesses, so they do things very well. So to focus on what we do, we're going to do well, and some of the 3 biggest differences I think you'll find is that, especially with our suite here, we're waiving management fees again. So the fees is going to be a huge, I feel, factor in making these decisions, all else equal. So after that, after we waive that management fee, it's just going to be 29 basis points. That's going to keep us the lowest in Canada, again, for the single stock side covered call market. And lower fees mean your investors just keep more of the returns. The second is really the philosophy at Ninepoint. Everyone has a different philosophy. It's going to be more dynamic. more manager driven. It's not going to be formulaic. So our approach is very dynamic. We don't follow any rigid playbook. Our managers will decide when to write calls, how much, at what strike, and always with an eye on the market conditions. So you have that expert management happening in the background for something here. And then on the other side, it's really the firm death. You talked about the 7 billion. Ninepoint isn't a one-trick shop. We're an alternatives manager with expertise, as we mentioned, in energy, real assets, fixed income strategies, and that wider perspective, in my opinion, gives us a much more comprehensive view of risk. So while all other covered call ETFs may have a combination of things, we believe that combination of fee leadership, the flexibility, and the firm depth gives investors a really smart option to consider.
Yeah, I think if I'm an investor, like on the other side of this conversation, who's just watching it, I mean, I think a couple of key takeaways that makes you guys different. I mean, by far none, as you mentioned, fees. That directly corresponds to potential distributions you're able to pay out, right? And then on top of that is, especially on the diversified ECHI, is that being yield weighted there. So with it, taking more of the single stock ETFs that you have in your lineup, and then creating a little bit more of a higher yield that way. So if investors are, truly, like you said, it's an income first product, as it should be. It's a cover call ETF product. But if investors are looking for that potentially higher yield, if that's what they want with the leverage, well, then they have a product like ECHI that can potentially offer that with those lower fees as well. So I think to your point, I think that is a good easy enough understanding of what makes you guys different, along with, even though these are new products and maybe there hasn't been much exposure of Ninepoint to the investors on the other side of this, they can clearly see that no, Ninepoint truly is a massive player. They're just a little bit newer to the cover call ETF space, right?
Yeah.
So it's good to see that there. All right, that's awesome. I have one more question for you, Carl. And even though these funds, as of time of recording, have only been out for a day, there is no way I could not ask this question. Will there be potentially other high shares, single stock cover call ETFs in the lineup? Would you add them into ECHI, or is this is going to be kind of like 7 questions in one question?
Yeah.
Put them all in
Great
one.
last question.
Right? Will there be like other funds that you potentially get into that are above and beyond high shares? Like what does basically the future potentially look like now that you guys are in the cover call ETF space?
And we've I think this has been a great suite. Like, to come with 11 products, that's a sizable investment by the firm. It shows we believe in it. And it's so scalable. That's what's so wonderful. Think about all the companies available. This is the Canadian. We saw some, again, white space earlier in my career. It was a lot more. Now we saw some white space on the Canadian side. We clearly have some competition, which shows that there's investor demand. That's the first thing I should have said on the last thing as well, is that it shows that investors are interested. We had a first successful day of trading yesterday. You mentioned that, so that's great. And part of it is that we have lots of information to share with people. People don't know who we are, and we've seen the interest already. But we're gonna really grow thoughtfully. And you mentioned there how we're thinking about things. Certainly on the Canadian side, we'll focus on where investors actually need solutions, where we can probably solve problems for them. So that could be more single stocks on the Canadian side. We could look at the US side as well. Globally, there hasn't been any European. I don't want to give our competitors ideas, but there hasn't been any European or some other global stocks on the single stock side listed on TSX. Mm-hmm. There's also, we talked a little bit, Tim, like geographically, this can look at different borders outside of Canada and list on various different exchanges. So I think there's a huge opportunity set. And there's more for that diversified basket, the fund of funds, the ECHI. to include these names, of course. So the way ours will work on ECHI is that there's going to be no maximum that we can add. I should mention, though, there will be a sector max. Sorry, a company max. So each position has a max weight of 15%. And that's done to avoid over concentration, for example, in just waiting in Shopify and Cameco, because they'll be the highest yielders. And so we want to have a diversified, but we can keep on adding, and the methodology allows us to do that. We're just going to make sure we won't chase every fad. Every launch will really align with our principle of outcome driven investing. And Canadians are telling us they want smarter income solutions, and we will deliver them with innovation, but also with discipline. So we're not just launching products to fill shelves. We're going to very much listen to, hopefully, your audience. I love the ideas that come from your audience and yourself, and we can form a relationship that way, because we do listen to those comments and feedback in order to how we do things.
Absolutely. Well, Carl, I appreciate you coming on the channel, explaining all the details regarding the Ninepoint Highshares. I think this is another wonderful addition to the Canadian landscape when it comes to income. Certainly a burgeoning community that has year over year has seen more and more funds. I mean, I thought maybe after 2023 that we'd start to see a less. Nope, wrong. We see more, and this year alone, we're seeing more than 2024. So it's great to see. It's great for content creators like myself get to meet people like you and discuss how these products can offer up real unique solutions for investors' needs. So thank you so much, Carl, for coming on to Cover Call ETF Investing.
Thank you, everyone. Nice to meet you.